Your margin is because of this extra FSI that you get, that you sell in the open market.
So our margins come in from two fronts. One is we buy the land cheap.
Yes.
Secondly, we get FSI 3 without paying for it. We get a little bit of a discount on the approval cost because we're rehousing tenants. We pay under certain heads. If I have to give you, we buy the land at a 20 to 30% discount from the market price. Construction cost remains the same. There's a rental cost which is added and approval cost. So I can give you a total breakup of roughly about 23,000 to 24,000 in a general parlance would be the cost, all-in cost. We work on three categories: 1 BHK, which is the value luxury concept, 1 and 2 BHKs, luxury, which is 3 and 4 BHKs, and of course the commercial. These are the three elements of what developing. Our 1 BHKs would start with the price range of 40,000 per square foot.
And see, real estate developers on con call, they say that Mumbai market is much more rewarding than any other market in the entirety of India. Like if I'm the value that they realize from a 10,000 square feet sale in Delhi or any other tier 1 city, they get that from 1,000 square feet in Mumbai. Is the cost significantly different to develop a property in Mumbai? And what is the main reason? What is that one time during these 39 years that things did go wrong? To someone outside Mumbai, paying 15 crores for a 1,500 square feet sounds absurd. So what's the psychology behind this purchase by people in Mumbai? Hi everyone, today we are with Suraj Estate Developers. It's a 1,700 crore market cap company. What makes this company interesting is that they have raised nearly 700 crores from the public markets by diluting the promoter holding as well to expand the real estate portfolio and pay down debt. And unlike a DLF or a Godrej Properties, what they do is they redevelop existing buildings that are more than 50 years old. And they provide free of cost housing to those previous tenants, and they make their margins based on a concept called higher FSI. To understand more about this subject, what an FSI is and about this new portfolio that they're building, we have with us the second generation promoter, Mr. Rahul Thomas with us. Hey Rahul, thanks for being on the show.
Hi Shriyam, thank you. Thanks for having me.
The first question, before I started researching, my initial thought was that you're like a DLF or a Godrej that buys land bank and makes mega launches, then builds the project, then recognizes revenue eventually. But then I later realized that you're into redevelopments. So tell me exactly what redevelopment is, and if you're providing free of cost housing to the existing tenants and giving a portion of that to the government, how are you recognizing revenues?
Correct. So what we're doing predominantly is redevelopment. So it entails buying the land. The only difference is that it is not a vacant land. These are lands sitting on where land tenants are sitting on the land today. We buy that obviously at a discounted cost. So that is where our margins come in. Our land costs when we acquire these lands are on the lower side. We have the expertise since 1986 is when my dad started the company. We rehoused over 1,100 tenants free of cost.
Okay.
So our expertise is buying the land at a discounted value, giving free accommodation to the tenants. We need 51% consent before any redevelopment takes shape.
Okay.
Whether it's society redevelopment, which is a new phenomenon where we also do that under 33(7)(b, and we do cessed property redevelopment under 33(7). So the two major categories of redevelopment which we are doing currently is 33(7) and 33(7)(b). Okay. One is where you buy the land upfront, obviously at the discounted value, rehouse the tenants, get consent of 51% consent, and then of course give them free accommodation, rental for the initial period while they are out, and the balance is for your free sale. Okay. While 33(7)(b, which is redevelopment of society lands where 30 years and older, are governed by a different regulation where the FSI depends on the road which it is abutting and it's facing. You still get 3 FSI, but there's no land cost over there. So these are the two forms of redevelopment predominantly done by Suraj as a group. Okay. We also do vacant lands. So these are the three main areas of redevelopment and vacant land development which we do. Okay. So 37B is that 33(7)(b. 33(7)(b is that you don't acquire a building, you take that building and say that to the landlord that we'll redevelop. These are actually societies. So it is a collective society who's the landlord. Okay. Since it's 30 years and older, they want redevelopment. Okay. So that is where under the new DCR, they are entitled for redevelopment with high FSI.
Okay.
So they approach someone like us who, there's so many societies in Mumbai who want redevelopment at prime locations which are 30 years and older. If you're abutting a major road, depending on the road width, you're
Okay.
governed by the FSI.
Okay.
And in most cases, it's 3 FSI because you're governed by the main road.
Understood.
So, but only difference between 33.7 and 33.7B is that in 33.7, when you're redeveloping, we get 3 FSI, which is an entitlement because you're redeveloping those cessed properties.
Okay.
We do not have to buy the FSI.
Okay.
While under 33.7B, you have to buy the TDR and premium FSI from the BMC.
Okay.
So there's a cost attached to acquiring that FSI.
Okay. What is FSI? Just break that term and give an example.
So it's the full form of FSI is floor space index. Depending on the land size and depending on the FSI which is governing that particular land, you can develop that much more. To just make it simple, just suppose you have 1,000-meter land, you have 3 FSI which are entitled under 33.7 or 33.7B.
Yeah.
So you can go up to 3,000 meters.
Okay. Like in height, or
no, 3,000 meters is your built-up space.
No, in terms of build-up space in height, like if there is a one floor of 1,000
Yeah, so again
square.
depending on your open spaces, then you're governed by the open spaces required by the CFO and the MCGM to govern what coverage you get.
Okay.
And then with that coverage, and depending have a height, there's a height restriction, you can go up to 70 meters.
Okay.
If you have 2 staircases, so there are many rules depending on each product, each project, how much FSI you can use. But just a thumb rule, whatever FSI, 3 FSI, you can use 3,000 meters. That would be a thing. And you have another component called fungible area, which is 35% over and above that.
Okay. So let's say 1,000 square feet area, okay, and it's 3 FSI. So you can build up to 3 floors, assuming that each floor is 1,000 square feet.
Correct.
Assuming it's a 3 FSI.
Yes.
Right? Okay. And in 30...
And then you have something called fungible FSI,
Yeah.
which is 35% over and above that.
That you can buy from the government? Or the government gives to you?
Yes.
Okay.
So for tenants, it's free.
Okay.
For a sale component, you have to buy that.
Understood. Understood. So under 33.7B, you're saying that the existing tenants, you build a new building. Okay, you rehabilitate them somewhere else where they live free of cost, and
We
this
give them
building-
rent.
Yeah.
For the temporary period.
Okay.
And then, of course, these are society members. Under 33.7B, they're society members.
Okay.
They're not tenants.
Okay.
So they're actually owners who have been displaced for
Right.
rent in the interim till you develop that building.
Okay.
Of course, so the category is a little higher than a tenant
Okay.
because they're technically owners
The
of that. Owners.
Right. Yes.
It entails the difference between 33.7 and 33.7B, as I told you, is these owners are a little more high end, so the rental cost is a little higher.
Okay.
You have to buy the FSI from the government because it's not coming inherent with the land.
Mm-hmm.
While in 33.7B, you have tenants. There is a land cost entailing when you buy the land. But of course, these tenants, once you get 51% consent, you don't have to buy the FSI from it's coming as an entitlement with the land.
Understood. And your margin is because of this extra FSI that you get, that you sell in the open market.
Yes. So the margins come from 2 things under 33.7. One is you're buying the land obviously at a lower cost because it's not a vacant land, right? So the risk attached to it is that maybe tenants, will you get consent or will you not get consent of 51%?
Okay.
So that's where we come in. We rehouse over 1,100 tenants free of cost. We give good quality tenant buildings to the tenants. We make sure that they're getting 405 square feet well planned apartments. By virtue of us giving good quality housing, rehousing, and a track record, we make sure that we get a consent very fast and give them good quality housing, and that's where we are differentiating ourselves from other developers. So our margins come in from 2 fronts. One is we buy the land cheap.
Yes.
Secondly, we get FSI 3 without paying for it, and the approval cost overall is we get a little bit of a discount on the approval cost because we're rehousing tenants. We pay under certain heads like open space, deficiency, which runs into crores. We pay only 10% of that under 33.7.
Okay.
So your margins overall in a prime land are on account of all these 3 factors.
Okay. Then how much do you realize while you sell this on average per square feet?
It again depends from project to project. I cannot give you an exact, as a thumb rule. If I have to give you, we buy the land at a 20 to 30% discount from the market price.
Okay.
Construction cost remains the same. There's a rental cost which is added and approval cost. So I can give you a total breakup of roughly about 23,000 to 24,000 in a general parlance would be the cost, all in cost. And 1 BHKs, we work on three categories. 1 BHK, which is the value luxury concept, 1 and 2 BHKs, luxury, which is 3 and 4 BHKs, and of course the commercial. These are the three elements of what you're developing. 1 BHKs would start with the price range of 40,000 per square foot.
Okay.
So our margins would be in the range of 40%.
40%. That's EBITDA margins, you mean?
Yes.
Of the entire revenue?
Yes.
Okay. And then what are the main challenges? I just want to stick to the redevelopment topic itself. What are the main challenges that you see? Let's say you said 51% has to approve.
Correct.
What about the other 49%? What if they don't approve?
So that's, see, the reason we have to understand, let us understand the psyche of the tenant. Why would they not want to go for redevelopment? The idea is once a 51% consent, by law, the others have to kind of abide to that law, because it's again tried and tested in High Court, Supreme Court. So the question of the others not aligning to redevelopment doesn't arise, because the minority cannot stop the majority. That's the rule of the law.
Okay.
Having said that, let's understand what we're giving them.
Yeah.
Today, if you're under 33.7, an average size of tenement would be 100 to 200 square feet, while we're giving them 405 square feet free of cost. So they're getting almost double the area.
Yes.
They have tenancy right today. They're getting ownership right. They can mortgage that flat tomorrow, raise funds, go for a loan, take a student loan for their kids. So a lot of benefits for the tenants becoming owners. Plus today they're using common toilets. They're getting 2 toilets and washroom within the 400 square feet which you're planning. So it's a win-win situation. The chances of them, unless there are a few bad apples in every project, and I think for that, the law is very clear that once 51% consent comes, the others can't stop. So that's the rule of the law. But in general, we don't see any thing unless it's someone who's coming, as a bad apple.
Okay. Because see, where I'm coming from is a very candid thought is relatively you are a new player. Okay. And if a person is supposed to go to a temporary stay, okay, for 3, even 6 years, unless you've built this project, then they would have a skepticism that what if this project stalls? Then what happens to my space?
So, Shirab, we actually have been doing this in 1986. So, this is the 38th year of us doing redevelopment. We are a new player in the public listed space, but from redevelopment, we are pioneers in redevelopment in 1986. So, we completed 42 projects. Right now, as we speak, we're doing 13 ongoing sites. So, the credibility is already built with the tenants.
Okay.
Initially, of course, when we just started our first project, maybe this question which you said is that the skepticism whether we will be rehoused finally, that comes in. But today, after the 38th year and being in a listed space, I think we've already passed that, we've crossed that bridge.
Okay.
Now it is more that they want us to develop their lands because we have that edge of making sure that the quality we are giving to the tenants and the tenant building is definitely high quality design, because if the land is big, we make 2 buildings. If the land is small, our sale and our tenants remain in the same building.
Yeah.
So it is in our interest that the quality which we give to the tenant building, whether it is the same building or whether it's 2 separate buildings adjoining each other, aesthetically, planning wise, all go in, are all coherent, because our sale, finally our customers are buying in the same building.
Yes, yes.
So it's important for us and imperative to make sure that the quality in the tenant and the sale building is at par.
Because your revenues depend on that.
Yes, and finally, a person who's paying us top dollar to buy an apartment does not want to buy in a place where he's facing a slum building, right?
True.
So both should look like sale buildings. Of course, by virtue of the size, we're giving them 400 square feet. By virtue of size, that building will obviously comprise of smaller apartments, but aesthetically, both should look pleasing.
Okay. Like there are, in the region that you operate in, which I believe is south central region of Mumbai, there are other players as well. Like Godrej is there, Lodha is there. There is Suntech, if I'm not wrong. So, and you hold an 8%, 10% market share in the region.
Correct.
Okay. And your size that you bid for, the projects that you do is like 75 crores, while they do 300 crores, 400 crore project. So do you plan to increase that size and go into more premium segments?
So I would say in the redevelopment space, we are also doing very large, we are taking larger bets. Our commercial is obviously, we are the first first phase earlier was about 1 lakh of square feet. With the acquisition of the second one, we have about 2,18,000. So, of course, in South Central Mumbai, I think we are looking at right now, after being listed, we're looking at larger footprints and larger projects. So that's where we are as a group. We're looking at larger projects now.
Okay.
Even for society redevelopment, we do not do very, very small projects, because finally the effort remains the same. Whether it is a small or a big project, the approval process remains the same. And, so finally we need to show revenue, we need to show pre-sales. So larger only makes sense from where we are as of now.
Great. And that is redevelopment project part of your business. Then you've got two other segments, if I'm not wrong. One is the commercial space that you built, and second is you've bought a couple of land parcels with the money that you've raised. So what are your plans with that?
So to answer on the commercial segment, so as I said, we're doing in the residential, we have two categories: value luxury and luxury. Value luxury would entail 1 and 2 BHK homes, anything from the area between 300 square feet, which is the minimum area, to about 600 square feet. So these are budget homes at prime locations of the city, where we're providing good quality housing for people who have a budget in mind,
Okay.
but also want to stay in a very prime location of the city. So that's kind of tapping into that audience. We have luxury space, something like how we're sitting today, where you have 9 levels car park, you have big apartments, penthouses, duplex, obviously targeting the HNIs and the ultra HNIs. So this is getting to that audience. These clients predominantly want amenities in the building. They want swimming pool. It's getting to that audience. The third segment is commercial, where we do build to suit commercial premises. So we've done that for Saraswat Bank. We've done it for Clearing Corporation of India Limited. So basic corporate offices to big corporate houses.
Right.
And now we're doing one on Tulsi Pipe Road. Again, larger floor plates, larger formats, catering to the corporate houses for their corporate offices. That's the segment which you're operating in the commercial space.
This corporate space that you said, do they buy the land and give it to you to develop?
No, we buy the land. It's our land.
Okay.
We do build to suit for their corporate requirements.
Okay.
For their head offices. That's how we do. So in our land now, for example, on Tulsi Pipe Road, we have a lot of options. Someone who wants to buy anything from 18,000 all the way to 1 lakh square feet, we have different options for them.
Great. And this money, again, coming to the money that you've raised for these new projects. So what is the status with that?
So we raised originally, when we raised 400 crores in the IPO. Most of the funds went for debt repayment. That was the objects of the issue, which is mentioned in our DRH.
285 crores went into debt repayment.
So majority went into debt repayment, and some went for general corporate purposes.
Okay.
So we did not put much money on the land at that particular point in time, because our objects were different at that time.
Right.
Once we raised preferential, we bought this land on Tulsi Pipe Road, which is the commercial I spoke about. We earlier had 1,500 square meters land. Now we bought another 1,500 meters. So now it's a 3,000 square meter land with a great frontage. And in this case, under 3319, you're eligible for 5 FSI. So technically, our square footage goes up for the amalgamated land.
Okay.
So roughly about between 218 to 220 would be the carpet area for sale.
Okay, great. And this is going to be used by corporates?
That's our endeavor, yes.
Okay. So redevelopment projects and corporates. All the land that you've been buying is for developing corporate buildings.
In commercial space.
In commercial
In
space.
redevelopment, we have two categories, as I said, value and luxury.
Okay.
Depending on if your land is sitting right on the front of the sea face, we obviously are going to do luxury projects there.
Yes.
So we make sure we try to make 2 separate buildings. One to rehouse the tenants, which look aesthetically pleasing, and one sale building for dealing, to sell to HNIs and ultra HNIs.
Okay. Once you have acquired the land or taken it from the owner, what is the next step? Like, do you employ your own construction workers or is it outsourced?
So we have our in-house team of designers, our in-house team of what we should build, of architects, who we all kind of hurdle and understand what we should build in this particular land parcel. Once that's done, of course, we go to the best architects in town, depending on the scale of the project, depending on who can deliver the best product. We make sure that we go to the architect.
Okay.
Once the design brief is given to the architect and we have the initial designs, we make sure the construction, which is actual contracting work, we outsource the contracting to one of the leading contractors.
Okay.
and that's so they do the actual construction. We bring in the entire project together, whether it's a design element, selling is done in-house, the marketing, the positioning of that particular product. Only the contracting part is outsourced to the outside contractors.
Materials are bought by them as well.
So we have two options. We also outsource the contracting either on labor or with material, depending on the scale of the contract. Both options are available to us.
Okay. Just a genuine question. During these last 5 years, have you seen the material prices go up and your cost go up?
Absolutely, substantially. Steel, labor rates, labor especially. So right now what we see witnessing is labor is not easily available across the site. So even though we outsource the contracting, labor comes under their purview. But we understand in general it's a very seasonal kind of thing. Sometimes, they go back to their village, so that in labor there's a shortfall. So all over Mumbai, we see this kind of, thing where there is a shortfall of labor and the labor cost overall has gone up.
Okay. And see, real estate developers on con call, they say that Mumbai market is much more rewarding than any other market in the entirety of India. Like if the value that they realize from a 10,000 square feet sale in Delhi or any other tier 1 city, they get that from 1,000 square feet in Mumbai, selling 1,000 square feet in Mumbai. Like DLF, for example, is coming into the Mumbai market now. So is the cost significantly different to develop a property in Mumbai? And what is the main reason?
So first, let's talk about the selling price. I think Delhi and Mumbai, pretty much, if you're talking about a very prime location of Delhi and Mumbai, would be at par.
Okay.
The other cities, there's a big difference and differential. You need, like for example, Chennai or Bangalore for that matter. You have to do a lot of volume to bring in the same business what you would do in Mumbai.
Yes.
Delhi and Mumbai, pretty much the rates are at prime location, almost at par.
Okay.
Coming to the cost, of course, Mumbai, you don't get that much land availability. Availability of land is limited. As I said, hardly any vacant lands available. So the only option to go is redevelopment. So you have other listed peers also who are getting into redevelopment space today.
Yes.
So larger societies, larger formats, they want to get a project with amenities, but they're not getting vacant lands in Mumbai. So that's almost done because mill land's already kind of exploited. So I think society redevelopment is the only way forward. And you get under different schemes, you have larger tracts of land, which is under the redevelopment category, which I feel have the potential to kind of bring in that top line and that size.
Okay. But just in general, like see, materials, more or less it's the same. Materials like concrete, cement, whatever it is, steel, it's the same price throughout the states, right?
Correct.
But labor, other cost of production, is it higher in Mumbai compared to that of other regions?
See, labor overall, from a construction cost element, as I said, there will be obviously, it will be a bit higher.
Okay.
But I don't see that much of a delta on the construction cost per se. I think the major cost, overall, as a thumb rule, anything between 3,000 to 4,000 on your construction area would be the rough cost for completing a project.
Okay.
Depending again, value luxury, depending on what kind of amenities. But I'm saying as a ballpark.
So 3,000, 4,000 rupees per square feet?
On the construction cost, on the construction area.
Okay.
Would be the rough ballpark figure if you want to make a good development.
Okay.
Having said that, what is important is you have other costs. The land cost, which is your major component in your overall cost structure.
Yes.
You have another thing called premium cost, which, that is a major cost which you have to pay to the MCGM or the local municipality, which is the major cost before we start a project. Of course, you have schemes of installment and everything, which the government has, very well come up with to boost the real estate sector. But having said that, today it is a cost.
Okay.
So you have land cost, you have approval cost, and of course, tenant rental cost is not too much in the overall cost structure. But these are the two elements which are the major cost today. And then, of course, you have had
Okay.
So if I had to put in the larger cost, it would be land and approval cost more than the construction cost, which is really creating why the cost is going up today.
Okay, so if
the approval costs are linked to Ready Reckoner.
Ready?
Reckoner, which is the circle rate, as you call it.
Okay.
So your charges are linked to Ready Reckoner. So every year, as it goes up, your approval costs keep going up.
Understood. So if I were to break this into 5 elements, why Mumbai real estate is more expensive to develop rather than any other tier 1 cities, it's because, see, materials more or less the same because it's commodities. Second, labor, it's slightly expensive in Mumbai, but not that much that it's going to make a big difference. Third, land. Land is very
Land.
expensive.
Absolutely.
Because per square feet charge, and to get through that bureaucracy and through the approvals, it's very expensive.
Correct.
This is it, right?
And no, when I say the approval cost, it is official approval cost which you need to pay upfront. What is important we are discussing is about buying the TDR and buying the premium FSI from the municipality.
Okay.
These are all payments required before you even get your CC.
Okay.
So this has to be coming from your promoter equity. So land approval costs need to come in from the developer's equity, and then you have construction finance which banks give you. So you have a respite for construction costs because banks are quite open to give you construction finance.
Right.
But as soon as you want to get funding for approval costs, your costing goes up a little because then only NBFCs are technically allowed to fund that. Banks are not allowed to pay anything related to land payments, and FSI comes under land payments.
And for land, acquiring land, and you need financing for that, you'd be paying what, 17%, 20% interest?
So technically, banks are not allowed to fund land.
Yes.
Nor are NBFCs.
Okay.
So there are different structures available. AIFs can do it, but they are very, very selective on doing something.
NBFCs can't sponsor land?
No, it's not allowed under RBI.
Okay.
So it is under AIF structure is what most people are doing right now.
Okay.
But that also very selectively.
How about you? How do you buy the land?
So we obviously most of the land which we've already bought is our equity. Very selectively we have AIF structure from leading, like maybe ICICI Venture, who gives us funding for land, but that's again very selective. We don't go for land stage because it's a bit expensive.
Okay. If they are sponsoring the land, if they're lending money for the land, do you pay them interest or equity? How is it?
Yeah, we pay them interest.
Interest.
Yes.
On average, 17-20%?
Not 20.
Okay,
about
slightly
between
lower.
the 16 to 17% would be the range
Okay.
if you're going under land funding.
Okay. I presume this is Cat 1 AIF, right?
Yeah, it's a
Cat
AIF structure, yeah.
Okay. And see, you have been in the business for how long, personally?
So I have personally been in the last 15 years, over 15 years.
15. I'm sure you would have seen at least 2 cycles in these last 15 years.
Correct.
I think 2007, 2009 was a bad time for real estate market. And then until 2018, it did well. And then after that, it slowed down again until 2021, 2020. So in these markets, what is things that have gone wrong? Okay. And during the bull market, what are the things that are going right?
So I think you need to understand where the market is going and what is selling. I think what is important, what we've learned in the hard times was you have to make sure that you know what your customers want and what they can afford.
Okay.
So I think most people go wrong on the sizing of the apartments. And now everyone in the bull market is only doing larger formats. Suddenly market corrects, you are sitting with inventory. So I think you should have a good balance. Of course, depending on your plot size and the location, you need to plan it. But as a strategy, we make sure that most of our running ongoing sites and upcoming projects, we have 60% in the value luxury concept.
Okay.
Where you have 1 and 2 BHK homes. That's going to happen in every market. So today, there will never be a day when no one wants a 1 BHK or 2 BHK.
Right.
So you're tapping to the larger audience. You still have luxury because in some very, very prime plots, making 1 BHKs will not suffice because the per square foot rate, for example, in Bandra or close to Prabhadevi near the beach is about a lakh per square foot. So doing 1 BHK there will not really make sense. So in those cases, you will take a chance of going for the larger apartments, that is in vogue today. And then selectively commercial. Now, for example, this is the first time where we see commercial also very buoyant.
Okay.
So that's why we're betting big on commercial as well.
Okay.
So depending on where the market is going, you need to make sure that you have your ears on the ground and plan and change quickly as per what the scenario is today.
So you're saying that throughout this entire 39 years you've been in the business, your father was there in the business. You guys have been consistently been able to predict or nearly predict the markets?
See, we make sure that, so our concentration is South Central Mumbai.
Yeah.
We've been doing that since the last 38 years. So we understand the market, we understand what is selling for so many years. When you're doing consistently in and around, you know what is going to sell, what the customers want. So we understand the segment we are operating. As I said, value luxury, it's a no-brainer. 1 and 2 BHKs never go out of fashion. So that could be a churning mechanism. Luxury, of course, where you're really going to make your margins is luxury. So we make sure that we have one or two projects in the luxury segment for the margins to make sure that we have a good bottom line. And then commercial, right now we see a buoyancy in commercial. That's how we're kind of taking the bigger bets on the lands, like I said, on Tusi Pipe Road, where we're exclusively making commercial development, and of course because of the high index of FSI.
Okay. Like in a very, very candid fashion, what is that one time during these 39 years that things did go wrong? Things go wrong meaning maybe the market collapsed, maybe one of his projects got stuck. What was your toughest time during these last 39 years?
So I think we are in most of the projects we take construction finance, we take funding from NBFCs. So I think if financial commitments from NBFCs, if the credit flow is less and they don't give it to us, that's when projects kind of go slow. So I think that entire mechanism and the churn have to happen where the credit line is very clear from the NBFCs you choose or you partner with, because if they have any problem in disbursing funds, it will affect the overall project.
Okay, and has it happened to you before?
I can't say it happened. It's happened in certain cases where they say that we cannot disperse the entire money now. It will take some time for us to disperse. So it has happened in a couple of cases.
Okay.
Where what we want and what has been disbursed there's been a variance.
Okay.
So that then you have to depend on sale. The idea to go to construction finance or NBFCs is to make sure that whether sale happens or not, your project runs smoothly. So it's a very normal in case where sometimes NBFC don't fund for XYZ reasons. So I think that's when you need to have your own equity, or you have to make sure your sales are happening on time.
Okay. See, your market cap of the company is 1,700 crores. And during this conversation, you said something interesting, inventory. The inventory pile up is not a good thing, right? In your books.
Correct.
Because there's a lack of demand.
Correct.
Or something is going wrong. So in your books, there is a 908 crores of inventory. So, and that's a huge spike. So what is this 908 crores, even if not to the single rupee, but just give a...
So broadly, the inventory which is showing in our balance sheet is pretty much, you have to break it up. It is the ongoing sites, which is roughly around 300 odd CR.
Okay.
Where it is the money which is already lying in, which is spent, which is lying in inventory. It's not come in our P&L yet.
Okay.
And the balance would be upcoming projects, roughly around maybe about 500 to 600 crores, would be the land bank, which we've already have acquired at book value. Is lying and is showing as inventory. Of course, these are all projects which are going to be launched in the next 2 to 3 years. So of course, there will be revenue coming out of it. So today it's sitting under inventory.
Got it. You said that in the inventories, you've got like 908 crores, of which 620 crores is just the land bank. So when other companies are scouting for good land to start building on, you're already sitting on a good land. So how do you plan to improvise on this and eventually get that into the market?
So basically, right now we're doing 13 ongoing sites with 0.6 million square feet of carpet area. What is very interesting is the land bank which you already own is about 1 million square feet, which are yet to be launched. So that will come through 18 upcoming projects. These are very prime locations of Bandra, South Central Mumbai, larger formats. So we see the next 3 to 5 years, we're going to be very busy in developing our own lands. So if you're talking about 1 million square feet, with an average realization between 50 to 60,000, would be about 6,000 crores of top line only coming from the land which we already own.
If you don't mind, I want to go into a bit of accounting, because how for chemicals or pharma, how the revenue works and the order book works, it's pretty vanilla straightforward. But for real estate company, it is quite complex in how you recognize revenues, and a lot of things can go right or wrong over there. Okay, so how do you recognize revenues? Like let's say you've built like a very simple example, you have built a 10-floor building. Okay, one floor cost 1 crore, so 10 crore building, and only you've got demand for everything. Okay, everyone is committed money. The entire 10 floors is sold out. On paper, it's sold out, but of course they've not paid the entire sum, and neither is your project entirely complete. So with this example, can you tell me how the accounting works in terms of revenue recognition?
Correct. So first and foremost, we're following something called a percentage completion method.
Okay.
POCM. So even though, like you said in this example, we've sold out the entire project, maybe some people have paid, as for example, let's assume the project is at the plinth stage or the first floor stage. We've already incurred about 40% of the cost.
Okay.
We've collected about 40% from maybe 8 of the 10 clients,
Okay.
right? So generally for POCM, you need cost to be incurred.
Okay.
There has to be obligation to pay. That means that agreements have to be registered
Okay.
with those particular clients.
Okay.
And generally, cost has to be incurred compared to the overall cost, which is estimated. You have an
Okay.
estimated cost and how much have you incurred. Depending on the percentage you have incurred, you can recognize the sale.
Okay.
So in cases where people have already paid, you can recognize that sale up to the 45%. But example, the two people who haven't paid, and assuming
Right.
they paid only 10%, you
Yeah.
still recognize 45%, even though they
Okay.
don't pay, because you're going on the overall project basis.
Okay. And we've spoken about this before as well. That two people who have not paid, their 45%
Would
will be
come
shown
under
as revenue, but in
unbilled
the
revenue.
unbilled revenue, it will go under assets
Absolutely.
in the balance sheet.
Correct.
I think current assets will go under.
Yes.
Okay. And subsequent to that, there is a large increase in your other current assets and other non-current assets by around 463 crores in last 1 year. So you're saying that people have committed that they're going to pay, let's say 40% of your project is complete, but they've only paid 10%. So that net 30% is what is in this 463 crores.
Correct.
And in terms of debt, now coming into the debt, you have bought the land parcel slightly because of equity, then debt. So how's your scene? What is the debt level right now, and what is your plan to take it up towards?
So our debt levels currently would be about 430 crores. There's no plan to really increase the debt. It is
Okay.
by virtue of new launches which we are planning right now. As I
Alright.
said, the cycle of real estate requires a lot of capital upfront,
Okay.
where you pay for premiums, where you pay for your launch, mobilization advances before you actually really start the project. So that's where we require a bit of debt. So we see debt levels going up slightly because we have 2-3 launches planned very, very soon. So, but again, once sales come in, it kind of gets rationalized.
It's a cycle.
Yes. So temporary, it's a spike. Once the launch is done, sales happen, again comes down. So that's how the entire real estate kind of cycle works. But we see what is important, our debt equity ratios are maintained. We want to make sure that we don't increase our debt. Maybe temporarily for the launches, it's fine. But we're very, very wary of increasing it entirely.
Understood. I probably should have asked you this earlier, but I see a lot of terms being thrown around in the real estate space. Let's say realizations, collections, then pre-sales, then launches. So can you quickly tell me what each of these terms mean?
So pre-sales is very, very, it's a very vanilla, simple concept. Whatever you sold come under pre-sales. So today, for example, the example you said, 10 customers are booked, 1 crore each, apartment value. Whatever they paid, keep that aside as a token. As long as they're giving you a token, you can say that your pre-sales is 10 crores because you've sold 10 apartments.
Okay. Okay.
Right? Now coming to the same thing on realizations, of course, if you divide the 10 crores divided by the area you've sold, you come to know what is the average realization per square foot.
Okay.
So that comes under realization. Collection is what you've collected, assuming you've collected a token of 1 lakh into 10, that's your collections for the year. So of course, when you're doing multiple projects, whatever's coming into your bank account would be the collections.
Understood.
So your pre-sales and collections, there's always a lag because you're doing under construction. So your pre-sales, even though technically, for example, is 500 crores, your collection, unless you have earlier collections and earlier projects, or you have ready inventory, there would be a lag between your pre-sales and your collections.
Okay. I might fumble on this, but help me understand with an example that 10 floors, 1 crore each, 1 floor, 10 floors building. So the entire unit is worth 10 crores itself. And let's say someone has paid you 10% for that 1 crore first floor. Okay. So that 10% is what? 10 lakhs.
10 lakhs.
10 lakhs. 10 lakhs you would recognize as revenues. Yes.
No, it's not that simple. As I said, you need to incur minimum 20% of the overall estimated cost as well.
Okay.
The 10 crores would stand as an advance from customer. It will not be recognized as a revenue. When you incur 20% of the overall cost as a criteria, number one, agreements have been registered. Number two, then you can recognize on a percentage completion method, you can recognize that 10 rupees versus, depending on the percentage, you can recognize the revenue.
from what you've said, let me try to explain it in very simple numbers. Let's say 10 floors, one floor, 1 crore each, 10 customers, okay? And one customer has paid you 10% and the completion is nearly 40%.
Correct.
The 30% you recognize as revenues but unbilled revenues.
Correct.
Okay? And collections is 10%. They've given you 10%.
Yes.
That will not go into revenues again, right? Because that will be duplicacy of revenues.
No, that's what I said. But that will be the 10 will be 30 will be unbilled revenue.
Yes.
10 is already collected.
Correct. Okay.
So that's what you asked earlier.
And pre-sales will include the value of the entire floor,
And all the entire 10 floors because you sold
provided
everything.
that the 10 floors are sold.
Yeah.
Okay.
In this case, you said the 10 are sold already.
Okay.
So in that case, pre-sales will recognize any
Understood.
area you sold into the overall value is your pre-sales.
Okay, so even if the person has only paid 10%
Comes
and
under
booked
pre-sales.
the entire value 1 crore will come under pre-sales.
Pre-sales, correct.
Okay, so pre-sales need not equal revenue.
Pre-sale, yeah, because revenues is a lag because you're
Yes.
selling under construction.
Yes.
So by the time you have 2-3 years for your development, it keeps incurring depending on the percentage.
Yes.
While pre-sales is how much business have you done for the year, how much area and value of goods have you sold for the year.
Okay.
It's just a metrics to understand how much business are you doing in a year.
Got it.
And then revenue is depending on where your project is, and as I told you on these criteria, how much revenue you recognize from the pre-sale, overall pre-sale.
Okay. So let's say you recognize pre-sales as 100 crores, but in the revenue, it will be realized over next
Over
3,
time,
4,
because
5
your building
years.
is not ready, you're doing under
Yes.
construction.
Yes, yes. And that will be divided into unbilled revenues and actual revenues
Absolutely.
throughout
Correct.
the 4-5
Correct.
years. See, I'm trying to understand in a very
Correct.
easy manner
Absolutely.
so that audience is able to understand, even I'm able to understand.
Correct.
Great. And the new properties that you've purchased to build that commercial projects, what pre-sales are you planning for this financial year or the next financial year?
So I can't give you exact guidance today because that will be given in our quarterly calls.
Okay.
But I can tell you the top line. Definitely, as I said, 2,18,000 is the carpet area we are estimating from that particular project. So we have a 1,200 crore top line coming up from that project itself.
Just that project?
Yes.
Okay. 1,200 crores from there, and last FY25 you closed at 553 crore revenues?
Yes.
Yes. So what is your net like revenues consolidated you predict it's going to be in FY26?
See, we have to give a growth to our shareholders, but again, it's
Yeah.
too early to give a thing, but it'll be definitely, we're gunning for better revenue than last year.
Okay. I mean, 1,200 plus 500.
No, so this 1,200 is the top line. It comes
Top
under
line.
pre-sales that if I, example, sell that entire
Okay.
project to a corporate client,
Okay.
our pre-sales will be 1,200.
Pre-sales will be.
1,200, but depending on the criteria I said, depending on where the project is, we can only recognize some percentage of that. So since we're doing 13 ongoing sites,
Yeah.
everything's at different stages of construction. So there will be always some revenue coming from one project which is advanced stage, one project which is only 30%, one project which is almost completed, which you recognize 100%. So consolidated wise, we got a 550 crore revenue.
Okay. And next year, you believe it's going to be higher?
Target to go higher, yes.
Okay. And like, what about the margins? What I've seen is you have like 43-45% EBITDA margins. DLF has close to 30%. Godrej has 40%. So your margin is slightly higher than this. What is the main reason behind this?
So as I said, we are predominantly doing 33/7, where by virtue of 33/7 redevelopment, we are buying land cheaper.
Yeah.
Approval costs on the lower side. So our margins are coming in from there. Having said that, we also are doing lands which are already bought, which are historical in nature. So, consolidate, when you look at it collectively, one is you're doing lands which are historical lands. You're only putting approval costs in construction and developing them. So margins are a bit on the higher side. You're also doing as a going concern basis under 33/7, you're getting revenue. You have margins of approximately around the 40% range. So a mix of both is why our margins are on the higher side.
To someone outside Mumbai, paying 15 crores for a 1,500 square feet sounds absurd. So what's the psychology behind this purchase by people in Mumbai?
So today, Mumbai is a financial capital. Depending on the requirement of that particular HNI, you have anything ranging from 40 to 60 and 1 lakh onwards. So depending on the location, whether it's Bandra, Mount Mary, Palia, these are the locations, or South Mumbai, you have the per square foot rate starts with 1 lakh in a very prime location. Let's understand the government rate, which is pretty much the circle rate, which you call. starts in many cases between 38 to 40,000 in a place like Prabha Devi or South Central. So that's your starting point, right? While in tier 2 or tier 3 cities, a 40,000 per square foot rate, it seems absurdly high. But in Mumbai, it's the government circular below which you cannot even transact.
Okay.
So, I mean, there's a huge disparity again. And of course, you have luxury towers, you have sea views, which command that premium. So, the 1 lakh per square foot, which you give me an example, would be a project which is commanding, on the higher floor, premium view. 1 lakh would be a price which someone would pay in Mumbai, which is quite common.
During your redevelopment projects, you have to convince someone who's lived there for decades to move out. How do you do that?
So I think that's where the Suraj brand comes in and what we have done earlier. I think that there is no magic wand anyone has. It is your credibility. It is what you have delivered and how many people have you rehoused earlier. And that's why I feel that's where we come in as an expertise, where we make sure that we rehouse over 1,100 tenants free of cost, give them good quality housing. They're getting more area. So there's a tangible benefit for these tenants, and they're getting ownership right from their tenancy. Today they're sitting on 100 square feet, they're getting 400 square feet. So in all ways, tenants are benefited. They just want to make sure that there's a credible developer with a track record to bring them back and give them a final rehousing product. So I think that's where we have that advantage.
There's a general idea that's going around that Dubai is much cheaper than Mumbai in terms of real estate. Is that true, and what makes people think this?
See, as an investment return from in residential, you have a higher return from a rental perspective. But the demand in Mumbai itself is so much that we see that, especially the value luxury 1 and 2 BHKs is a huge, look at the population we're living in. By virtue of the population, there's a huge demand and surge in housing requirements in the city. Of course, as you go higher with the ticket sizes, you have, HNIs and ultra HNIs coming to buy. But we feel like if you're in a good segment, in a good price range, there's no reason this is the place to be.
Okay, you're saying that Dubai is better return oriented than Mumbai?
From a residential rental standpoint.
I think that's all from my side. Thank you so much.
Thanks.